Vodacom has revised its half-year profit outlook. This follows a once-off cost tied to the settlement of its Please Call Me dispute. The mobile operator now expects headline earnings per share to rise between 30 and 40%. That's lower than the 40 to 45% range presented just last week. The revision follows Vodacom's decision to settle the Please Call Me matter with former employee Nkosana Makate out of court. The company says the agreement brings finality to a legal battle that has spanned more than a decade. Sibanye-Stillwater says it's delivered a pleasing third quarter performance. The miners' adjusted earnings before interest, tax, depreciation and amortization tripled to 9.9 billion rand, with Sibanye citing greater operational stability and higher metals prices. CEO Richard Stewart says the performance reflects the group's leverage to precious metal gains, which have continued into the fourth quarter. He's added that all operations contributed positively on an operating and all-in sustaining costs basis, except for the Sandouville nickel refinery in France, which is being placed on care and maintenance. Truworths has held its ground in a tough retail climate. The fashion group says total sales were flat at 7.2 billion rand for the first 18 weeks of its financial year, with stronger performance from its UK arm offsetting weaker trade at home, where tighter credit and lower demand weighed on growth. Sales at Truworths Africa fell 4%, while Office UK grew 6% in pounds and nearly 8% in rand terms. The group says its balance sheet and cash generation remains strong, and it's resumed a share buyback program amid confidence in improving trading conditions ahead. Sappi has plunged into the red. The global pulp and paper group has posted a full-year loss of $177 million. It cited asset impairments and restructuring costs linked to its European business, as well as higher finance costs. Weak paper markets, softer dissolving wood pulp prices and currency swings also weighed. Despite the performance, Sappi says it remains confident in the strength of its operations and that it plans to sharpen its focus on cost savings and debt reduction. To support that drive, the group's cut annual capital spending to under $300 million for the next 2 years, with no major expansion projects planned. Europa Metals is growing its portfolio. The exploration company plans to acquire Marula Africa Mining Holdings via a reverse takeover. The move would give Europa access to battery and critical mineral assets across East and Southern Africa. Marula's projects span lithium, copper, manganese and rare earths, with several already in production. Europa says the deal aligns it with one of Africa's most diversified critical minerals portfolios, offering near-term cash flow potential amid growing global demand for electric vehicles and renewable energy. Further afield, AstraZeneca has topped third quarter earnings expectations, lifted by robust sales of its cancer, heart and kidney disease medicines. This puts the drug maker on track to meet its full-year forecasts. Here's more detail in this packaged report.
AstraZeneca beat third quarter earnings expectations. It was helped by strong sales of its cancer, heart and kidney disease drugs. The update led London's most valuable listed company to retain its full-year forecasts. AstraZeneca is making big strides to achieve its goal of $80 billion in annual revenues by 2030. It's betting on its expansion plans and drug pricing deal in its biggest market, the US, to provide some relief from import tariffs. Global drug makers have pledged billions of dollars to boost their manufacturing in the US to try and avoid tariffs. AstraZeneca will also list its shares on the New York Stock Exchange to gain access to a deeper capital pool. The Anglo-Swedish drug maker expects full-year revenue growth of a high single-digit percentage. It reported 10% growth of over $15 billion for the 3 months ending September the 30th.
And chip maker Nexperia anticipates a resolution to its control crisis, yet it has cautioned customers that products manufactured in China after October the 13th cannot be guaranteed as authentic or up to its quality standards. Here's more on that.
Dutch chip company Nexperia expects to resolve a crisis over control of the company. But it also warned customers it couldn't guarantee products made in China after October 13th were authentic or meet quality standards. The statement further said facilities in other countries are operating as normal. The Dutch government seized control of Nexperia in late September, citing lapses in governance. Chinese authorities then blocked exports of its products just days later from October 4th. That led to a shortage of Nexperia chips widely used by car makers. Nexperia welcomed news that it won't be subject to US export restrictions for 1 year under a US-China agreement. China has also said it will allow exports on a case-by-case basis. Nexperia's Chinese parent firm Wingtech is subject to US restrictions, while Wingtech founder Zhang Shejiang was suspended from his role as Nexperia CEO by a Dutch court in October.